Look, I'm not going to sugarcoat this. On January 27, 2025, a single Chinese AI company you've probably never heard of wiped out $589 billion from Nvidia's market cap in one day. That's not a typo. $589 billion gone. The Nasdaq dropped 3%. Tech stocks, absolute bloodbath. And here's the thing that's keeping me up at night. This wasn't a market crash because something broke. This was a wake-up call that the game we thought America was winning, China's been playing it differently and they might be winning. I've been tracking China economic relations for months and what I found is honestly terrifying. So before we get into it, hit that subscribe button because you're going to want to follow this story. It's moving fast. Let me take you back a bit so you understand what's really happening here. For years, China's been America's economic frenemy. We buy their stuff. They buy our bonds. Everybody makes money. But 2024, that's when things started getting weird. China's economy officially hit 5% GDP growth last year. Sounds okay, right? Wrong. When you dig into the numbers, it's actually pretty grim. According to the World Bank's December update, property investment in China fell 6%, the steepest decline since they started keeping records in 1987.
New construction starts down 23%. Property sales dropped 12.9%. Think about that. The property sector, which is basically the backbone of Chinese household wealth, is collapsing. So what did they do? In September 2024, Beijing finally pulled out what analysts are calling the fiscal policy bazooka. For the first time since 2011, they shifted to a moderately loose monetary policy. That's economic speak for we're panicking and throwing money at this. They announced 10 trillion yuan. That's about $14 trillion in local government debt refinancing. New liquidity facilities for the stock market, the works. And you know what? Chinese stocks actually surged. The MSCI China Index returned 61% between July and December 2024, according to data from Bloomberg. After 3 straight years of losses from 2021 to 2023, investors finally got a win. But here's what nobody's talking about. Less than 10% of Chinese households even own stocks. Compare that to over 60% in the US. So, while the market's popping, regular Chinese people, they're still broke and scared. Now, let's talk about the elephant in the room, Trump. During the 2024 campaign, Trump floated the idea of 60% tariffs on all Chinese goods. 60%. That's not a negotiation tactic. That's economic warfare. Multiple outlets reported on this threat throughout late 2024, and Chinese economists at BBVA Research estimated this could drag China's growth by around 1% if it actually happens. Doesn't sound like much until you realize China is only growing at 5% to begin with. But here's where it gets really interesting. And this shocked me when I saw the data. American companies are terrified. Let me give you some names. Apple gets 16% of its revenue from China. But here's the crazy part. Apple doesn't manufacture anything in the US. They make everything in China and sell it everywhere else. So if Trump slaps 145% tariffs on Chinese goods, that hits American customers, not Chinese ones. Your iPhone just got way more expensive. Tesla 21% of revenue from China. And get this, Tesla's China sales dropped 19% year-over-year in early 2024, according to the China Passenger Car Association. Meanwhile, Chinese EV maker BYD is eating their lunch. BYD reported a 29% jump in pure EV deliveries, while Tesla's market share in China shrank from 7% to 4% between March and April 2024. Nike manufactures most of its products in China and Vietnam. Intel gets 29% of its revenue from Chinese customers but manufactures in the US. The tariff war hits everybody differently, but it hits everybody.
Analysts from multiple firms, including MLY Full, noted that major US companies with China exposure, Apple, Tesla, Nike, Lululemon, Starbucks, all significantly underperformed the broader market throughout 2024, despite the S&P 500 being up over 20%. Want to know the really crazy part? After Nike reported earnings in March 2024, their stock dropped over 8%, Lululemon down over 19%. Not because their businesses were failing, because investors are pricing in China risk. Okay, now we get to the part that made me actually sit up in my chair. January 23 Road 2025, a Chinese startup called DeepSeek, founded in 2023 by a hedge fund guy named Ling Wenfeng, releases something called the R1I model. And it's really good. Like on par with Chat, GPT, Google's models, Meta's models, the kind of stuff that cost billions to develop. Except DeepSeek claims they did it for $5, $6 million, using 2,000 Nvidia chips instead of the 10,000 plus that us companies use. And they did it in 2 months. By January 27, DeepSeek's app shot to the #1 spot on Apple's App Store, pushing ChatGPT to second place. And then the market just imploded. Nvidia lost that $589 billion I mentioned, the biggest single-day loss in a stock market history. Microsoft dropped 2%, Alphabet fell 4%, Broadcom down 11%. The whole AI infrastructure story that Wall Street's been betting on, suddenly it's in question.
Marc Andre, one of the biggest tech investors in Silicon Valley, called it one of the most amazing and impressive breakthroughs I've ever seen. He literally compared it to the Soviet Union's Sputnik launch. That's how big a deal this is. Here's what freaked everybody out. The US has spent years restricting China's access to top AI chips. National security concerns, right? We cut off their supply of advanced NVIDIA chips, and they built this anyway, using less powerful H800 chips that aren't even banned. Think about what that means. Either DeepSeek is lying about the costs, and so far, nobody's really proven that, or China just proved you don't need to spend billions on AI infrastructure to compete. You just need to be smarter about it. Some analysts like Bernstein's Stacy Raskin think the market panic is overblown. He told Yahoo Finance that this doesn't spell doomsday for AI infrastructure. Others like Futurum's Daniel Newman say this is actually positive because more efficient AI means more adoption, which means more compute demand. But here's my take. Wall Street's not panicking because DeepSeek is good. Wall Street's panicking because America's AI lead just got a lot smaller, a lot faster than anyone expected. So what happens next? I see 3 possible scenarios.
Scenario 1. The trade war escalates. Trump takes office and actually implements those 60% tariffs. China retaliates. American companies with heavy China exposure, your Apples, your Teslas, your Nikes, they get crushed. Supply chains that took decades to build get ripped apart in months. According to CraneShares' 2025 outlook, some analysts think Trump might actually seek a grand bargain with China after using tariff threats as leverage. But that's optimistic thinking. If this goes south, we're looking at years of economic pain. Scenario 2. The AI race goes hyperspeed. DeepSeek proves this wasn't a fluke. Open source AI becomes the norm. Suddenly, the billions that US companies are spending on proprietary models looks like a massive waste. The entire AI value chain gets disrupted. But here's the flip side. If AI becomes cheaper and more efficient, adoption explodes. More companies use it. Productivity surges. The addressable market grows. According to IOT Analytics, end users and AI application providers could be the big winners here. Chinese tech stocks have already started bouncing back. The MCI China Index was up 13.9% year-to-date as of mid-February 2025, dramatically outperforming the MCI USA indexes for 4%. Analysts at AllianceBernstein think DeepSeek has created a halo effect that's making investors take a fresh look at Chinese tech companies. Scenario 3. Decoupling accelerates. This is the one that worries me most.
The US and China just split. Not completely, but enough. Companies frantically diversify supply chains. Critical technologies get siloed. The world fragments into competing tech spheres. Apple's already trying to hedge. Recent reports show they've intensified efforts to move manufacturing to India and Southeast Asia. But here's the problem. Every move they make to reduce China exposure pisses off Beijing. And Beijing can turn off iPhone sales in China like flipping a switch. According to Rest of World, Apple's China revenue already dropped over 10% in 2023, falling from just under $24 billion to just under $21 billion. That's a $3 billion haircut. And that was before things got really tense. Look, here's what you need to understand. The narrative that America is untouchable in tech, that just died. China's not just catching up. In some areas, they might be leapfrogging. The companies you own stock in, the products you buy, the entire global economy, it's all getting reshuffled right now. And it's happening fast. I'm not saying panic. I'm saying pay attention because the decisions that get made in Beijing and Washington over the next few months, they're going to
Gold
determine
often
whether your
grabs the
portfolio goes
headlines.
up or down,
Silver is
whether your
increasingly
iPhone
being
costs
viewed as a
$1,000 or
monetary metal
$2,000,
light,
whether we're
especially
looking
by
at a decade
countries
of
that-
prosperity or a decade of economic Cold War. So, here's what I want you to do. First, smash that subscribe button because I'm tracking this story every single week. Second, drop a comment and tell me, do you think American companies should pull out of China, or is that economic suicide? I'm genuinely curious what you think. And third, I'm going to have a video coming out next week about which specific stocks and sectors could actually benefit from this chaos. You're not going to want to miss that one. The US-China relationship just entered a new phase. The question isn't if things are
What most
changing,
people
it's
don't
whether you're ready for it. Thanks for watching. I'll see you in the next.